Welcome to the first birthday show of the Michael Yardney Podcast. Today I'm going to try and distill all the wisdom from the first 51 shows from myself and the many guest experts into one great show. So whether you're a beginning property investor or well down the track, I'm sure I've got something for you as you join us in the Michael Yardney Podcast.
Are you interested in property investing, success or money? Well, you're in the right place. This is the Michael Yardney Podcast, where each week you'll learn a number of new ideas regarding success, property investment and money in 20 minutes or less. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property advice. Now here's your host, Michael Yardney, who has once again been voted Australia's leading property investment advisor. That's the fourth time he's won a similar award in the last 6 years.
Welcome to the first birthday show of the Michael Yardney Podcast. Boy, have the last 52 weeks gone quickly. It was just over a year ago I decided it was time to have my own podcast, having been partner in a top podcast for over 5 years. In fact, I'd recorded my first podcast in 2007 and then did a lot more in 2008 and 2009 before they were even popular as podcasts. However, I've been so excited that I can speak to you every week, and now there's been over 250,000 downloads of the Michael Yardney Podcast, making us one of the highest ranking Australian business podcasts in iTunes. So what was I going to do for my first birthday show? What new information could I come up with? Well, later on, I'm going to share something with you about how I record these podcasts that you wouldn't know about. I'll tell you about that in a little while. And I decided rather than trying to come up with something new, I was going to distill the information, the investment philosophies, the tips and tricks that I and all the guests over the last year have shared with you in one mega episode. Now, I know that's a big ask, but let's see how we go with this. So here's my attempt. The first lesson I'd like to share with you is become financially fluent before you start investing in property. You see, the secret to financial freedom is to spend less than you earn, save the balance, and then invest your savings wisely in growth assets. It's going to be your job to learn how money, finance, and the property markets work, and then start investing early in your life so you've got time and compounding working on your side. But if you've left it late, don't worry. The alternative of not doing anything is not going to be good for you. So start learning and get some proven mentors and a good team around you. But here's the thing. Make sure you have a thorough knowledge base, because while you can delegate or outsource many tasks in your property investment, it's critical to understand if you're being given impartial advice or if you're being taken by one of the many vested interests after your money. That's why you've got to have a good basic knowledge. The second rule I'd like to share with you is that you've got to adopt a proven investment strategy. You see, not every investor succeeds. In fact, we know most don't. Half of those who get in property sell up after the first 5 years, and those who stay in, most never get more than 2 investment properties. On the other hand, smart property investors follow a system that takes the emotion out of their decisions and ensures they don't speculate. Now, I know this may be boring, but it's profitable. At my seminars, I say, hands up the intelligent people in the room. Hands up the analytical people in the room. And people aren't sure what I'm on about, and then I tell them, hey, you're in trouble. You see, my system for investing is sometimes too simple for these intelligent people. My system is to buy good assets and over time build a substantial asset base. And you do this by holding on to your investments for a reasonably long period of time, by reinvesting the income you're receiving and allowing capital gain to build up. You see, residential real estate's a high growth, relatively low yield investment. And that's why my system is a capital growth strategy. Now, I know people are going to say invest for cash flow, but residential real estate isn't a cash flow investment. And if you try to make it that, you're bastardizing it. It's not going to perform for you. I recognise that cash flow is important. Cash flow pays the mortgages and keeps you in the game. So I'm not saying don't get cash flow. But what I am saying is capital growth that's going to get you out of the rat race. So you've got to do it the right way around. First, concentrate on building a substantial asset base over a number of property cycles. then slowly lower your loan-to-value ratios, and eventually you can live off your cash machine. It's just too hard to get rich the other way around from savings from cash flow. Now, the worst thing that can happen to a property investor is to get it right first time, because they think they're smarter than they are. But that's what's happened to many beginning investors who bought in Melbourne or Sydney or some of the other places, Hobart at the moment. They timed the market well, or more likely luck smiled on them with their timing. And the value of their properties soared. But let's be honest, almost anyone can make money during a property boom, because property markets cover up mistakes. But in previous property cycles, many investors who didn't have a system found themselves in financial trouble when the market turned. You know, I love talking about Warren Buffett, who said you only find out who's swimming naked when the tide goes out. In other words, if you're not following a system that works in all market conditions, you could get caught naked when the market changes. On the other hand, if you prefer to get consistent profits and reduce your risk, and that's important, I'm suggesting you follow a proven system. In other words, make your investments boring so the rest of your life is exciting. But I've found many investors don't follow a plan. They don't have a strategy. And of those who do, time and time again, I've found so many people have invested so much of their time, energy, passion and money to build a property portfolio, but their model for how to develop financial freedom is simply wrong. To take your property investment business to the next level, you're going to have to do things differently to most property investors. You see, if you have the ladder up against the wrong wall, then every step you take is going to get you further from your destination. It's likely you're going to have to do things differently to what you've done to get to the level you already are now. The third lesson I'd like to share with you in this anniversary show is that there's not one property market. I know in the papers you're going to read about the property market or even the Sydney property markets, but there are very many sub-markets in Australia. Each state is at a different stage of its own property cycle, and within each state there are markets segmented by geography, by different price points, by different types of property. For example, currently the top end of the market's performing sluggishly. Property values are dropping at the higher end of the market. And there's another end of the market, the new home market, the new home buyer market, the outer suburban market, and that performs differently to the investor segment or medium-priced established properties. Another lesson you would have picked up if you've been listening to my show over the last year is that not every property is investment grade. Remember that while location of your property will account for probably about 80% of the performance of your investment property, it's also important to own the right property to suit the local demographics in that location. There are around 9.6 million dwellings in Australia at any time. There are 250,000 properties for sale. But not all properties make good investments. While virtually any property can become an investment, you kick out the landlord, put a tenant in, few properties are what I'm calling investment grade. Ones that are going to strongly outperform the averages over the long term. In my mind, in the current market, less than 2% of properties are what I'd call investment grade. While there are a lot of properties specifically built for the investor market, those high-rise towers or the house and land packages, most of these, in fact almost all of them, aren't investment grade. I'd be calling them investment stock. They are what property marketers and developers sell in bulk to naive investors. But they're not investment grade. Investment stock's different. Investment grade is what sophisticated investors buy. But these investment stock, they've got little owner-occupier appeal. They lack scarcity. And they're usually bought at a premium. And because they're new, there's no ability to add value. On the other hand, an investment grade property, and if you're not totally sure what it's about, go back to episode number 1. Listen to the first episode where I go into it in detail. But an investment grade property appeals to a wide range of affluent owner-occupiers. Not that you're going to sell, but they're the ones that buy with their emotion and push up the value of surrounding properties close to yours to push up the value of your property. So investment grade properties appeal to owner-occupiers. They're in the right location. By that I don't mean just the right suburb, one with multiple growth drivers, but they're a short walking distance to lifestyle amenities such as cafes, restaurants and parks. And they're close to public transport. And this is a factor that's going to become more and more important in the future as our populations grow, as our roads become more congested, and as people are going to want to reduce commuting time. We've got to learn the lessons from what's happened in the big cities overseas. Some other points about investment grade properties: they've got street appeal, they offer security, they have off-street parking, and in my mind they've got potential to add value through renovations, in other words, to manufacture some capital growth, and they've got a high land to asset ratio. Now, be cautious. This is different from a large amount of land. I'd rather own 1/6 of a block of land under my apartment building in a good inner suburb of one of our capital cities than a large block of land in regional Australia. As you've been listening to my shows, another lesson you would have learned is my interest in demographics, because I believe demographics drives our markets. Over the long term, how many of us there are, how we live, where we want to live, what we can afford to live in, those things are going to be much more important in shaping our property markets than the short-term ups and downs of interest rates, consumer confidence, or the government meddling into property. And as I've tried to explain over the last year, more of us are going to live in our capital cities rather than regional Australia, and the bulk of the population growth is going to occur in the 3 big East Coast capital cities, because that's where the economic growth is, and that is where the jobs are going to be created. So don't fight the trends. The 6th lesson I'd like to share with you today is that residential real estate's a game of finance, with some houses thrown in the middle. Strategic investors have always recognised that residential real estate's a long-term game, so they use finance not only to buy themselves properties, but to buy themselves time to ride the ups and downs of the property cycle. So they set up financial buffers to ride the cycle. They set up lines of credit or offset accounts, and they also protect their assets by owning them in the right ownership structures, and for many people that's trusts, and they protect themselves with insurance. Over the last year, I've shared many lessons, and many of them have been to talk about taking a long-term perspective, because residential real estate investment is a long-term game, yet many are trying to make it a fast money game. You've probably met those people. They look for the deal that's going to make them fabulously rich. When you see them the next year, they're usually no better off financially, and they're still talking about that next deal that's going to make them rich. They're often influenced by the latest get-rich-quick artist. They come up on the internet or at the seminars with a great story about how you can join them and become stupendously wealthy. Now, I know these stories can be compelling, they can be hard to resist, and they pander to people's wishes who'd like them to give up their day job to get into property full time. But in reality, it takes most people many, many years to accumulate sufficient assets to do this. So, patience is an investment virtue. Another Warren Buffett quote you've heard me say, wealth is the transfer of money from the impatient to the patient. That's so important, I'm going to say it once more. Wealth is the transfer of money from the impatient to the patient. The property market moves in cycles, and even though there are a few years of flat or falling prices every decade, well-located properties have increased in value on average around 7%, 8% per annum over the long term. Imagine if you could buy the house your parents bought at the price they paid, 30, 40 years ago. How many properties would you have bought then, knowing what they're worth today? So that lesson I wanted to share was that you've got to take a long-term perspective in residential real estate investment. Having said that, another lesson is that the economy and our property markets move in cycles. Now, it's a common fallacy that property cycles last 7 to 10 years. They vary in length, and they're affected by a myriad of social and economic factors. And then at times the government lengthens these cycles or shortens these cycles by changing economic policies or interest rates or the availability of credit. Market sentiment is another key driver of property cycles, and one of the reasons why our markets overreact. They overshoot during the booms and they get a bit too depressed during the slumps. Because during a boom, everyone's optimistic and expects the good times to last forever, just as we lose our confidence during a downturn. So remember, each property boom sets us up for the next downturn, just as each downturn, and we're having a little one at the moment, sets us up for the next upswing. And over the next decade, we're going to probably have a recession sometime. We're most likely going to have another depression one day. We're going to have periods of high interest rates, low interest rates. So cover yourself for all that's going to come ahead in our property cycle. Another lesson I'd like to share with you is that you should beware of doomsayers, because as long as I've been investing, and that's well over 40 years now, I remember hearing people with excuses why property prices are going to stop rising. In fact, they usually come up with reasons why property prices are going to crash, why they're going to plummet. However, in that time, well-located properties have doubled in value every 10 or more years. But these doomsayers use fear. And fear is a powerful emotion, and it's one that the media uses a lot to grab our attention, isn't it? And sadly, some people miss out on the opportunity to develop their own financial independence because they listen to messages of those who want to deflate the financial dreams of their fellow Australians. Now, before I move on to some more lessons from the first year of the Michael Yardney podcast, I said I was going to share a little secret with you about how I record these podcasts. Now, I tend to set aside Friday mornings to record these podcasts, so they're recorded in advance, and I do them from my home office because it's a bit quieter here. But I have a friend with me, and he's here at the moment spending time with me. One of my two cats, Bentley. Harley and Bentley are our two cats, Pam and my cats, but Harley, he's a bit quieter. Bentley loves walking around, and he's been stepping on the keyboard here of my computer and walking around and purring and buzzing and pushing me aside. But he loves being around. They're Burman cats, and he likes a bit of attention, which is what he's doing at the moment, distracting me a little bit as well. But Bentley's my mate, who's here as I'm speaking to you each week. Now, we're coming up for a short break, and when I come back, I've got another heap of great lessons that I've been wanting to share with you, and I hope I got the message across in the first year of the Michael Yardney podcast.
Are you wondering who you can turn to for independent and unbiased advice? Metropole has helped beginning investors buy their first property. Experienced investors add to their portfolio, and sophisticated investors manufacture capital growth by becoming property investors. The team at Metropole Property Strategists have been involved in over $2 billion worth of property transactions, creating wealth for their clients, and they can do the same for you. It's a great feeling having the independent team at Metropole helping you formulate and implement your wealth-building property investment strategy. Arrange a time for an obligation-free chat at metropole.com.au.
Welcome back. I've got some more lessons to share with you, and one of them is that it's important to follow my six-stranded approach to buying an investment property because it's a strategic approach. So what you've got to do is find the sort of property that's going to appeal to owner-occupiers. As I've said, they're the ones that push up property values around you. I also believe it's important to buy below intrinsic value, and that's why we avoid new and off-the-plan properties which come at a premium price. I like buying properties with a high land-to-asset ratio. And as I said, it doesn't necessarily mean a large block of land, but a property where the land component makes a significant part of the asset value. I also like buying in areas that have had in the past long-term capital growth, ones that have outperformed averages and that are going to continue to do so because of the demographics of the people that live there. And then I like looking for a property with a twist, something unique, something a bit special, something a bit different, something scarce about the property. And finally, an investment-grade property, in my mind, is one where you can manufacture some capital growth as well through renovations or development, rather than just waiting for the market to do the heavy lifting. The 11th lesson I'd like to share with you today is don't focus on bargains, because they rarely have a future. In today's informed world, there are very few bargains. Properties that no one else wants today are probably going to be the properties no one else is going to want in 5 years' time either. I can't remember who it was who said it, but they were very clever when they said, price is what you pay, value is what you get. So buy the best property your money can afford, the type of property you'd be happy to own for, 10 or 15 years' time. Another lesson I've shared over the last year is don't try and do it alone. Very few property investors can successfully build a true property investment business without having a core community of peers with whom they can associate, people they can share ideas with, get candid feedback and soak up new ideas. So how is your peer group going? It's been said that the level of your wealth is the average of the 5 closest friends you hang around with. So if you want to change your outcomes, have you considered upgrading your peer group? The top 2 reasons why a peer group matters so much is it's their attitudes, their beliefs and their behaviours, because that's contagious. They impact on the way you think, on your ability to spot and take advantage of opportunities, and on your behaviours as you go after or don't go after your financial goals. Alone you're vulnerable. Connected we are strong. We all have blind spots and limitations, but your peers can help you bridge your gaps and share resources to help you get better decisions, better final choices. Now, a lesson I learned a long time ago, and I've shared a few times with you, is allow for an X factor. Because you see, not like the music show, but every year there are a few X factors, which are unforeseen events or situations that blow out your best laid plans. These X factors can be negative or positive. They can come from local factors or overseas issues. So, despite the best laid plans, things will come out of the blue. Watch out for the X factor. Another lesson you've probably picked up by now is that there's always going to be a reason not to invest, because every year brings its own set of crises and lots of reasons not to invest. Currently, the news in property is mixed or bad in some cases, but you can go back as far in history as you like, and there won't be a crisis-free year. Sure, some years are worse than others, but there's always bad news, and much of it's unexpected. Where investors get into trouble is rather than focusing on their long-term goals, they see these crises as a once-in-a-generation event that'll alter the course of history, when in reality, they're just a normal path of history. Now, this is very easy for me to say, having invested for over 45 years, that I'm just used to these things. But the first time they hit you, it makes it hard. Another critical lesson to remember is you know less than you think you know. There's nearly an insurmountable amount of material to learn about the fields of property, about finance, about economics. The big lesson is that I know much less than I think I know. The markets are going to humble you if you don't check your ego at the door. So a continuing theme of the Michael Yardney podcast has been always continue learning. And I'm going to keep sharing these lessons with you about property, about success, about money every week. And I'd like to finish off with one last lesson. Now, there are so many lessons I could have shared, but this is an important one. Maybe it should have come first. Don't mistake money for wealth. I've often said that any problem money can solve isn't really a problem. While this means money is going to make your life easier to a certain degree, if you let money own you, it will make you miserable. I became a lot happier, I don't know, about 30 years ago when I realised that money isn't true wealth. And boy, did I learn that the hard way. True wealth is what you're left with when they take all of your money and your properties away. True wealth is your health, your family and your friends, your knowledge, your mindset, your spirituality, and your ability to contribute to society. Well, there you have it. Some of the lessons that I've tried to share with you in the first year of the Michael Yardney podcast, and I look forward to having a chat with you each week about success, about property, about money. Thank you so much for sharing the journey with me. Thank you for all those new listeners who join us every week, the existing listeners who keep coming back and giving us reviews. Can I ask you one favour, please? If you've got some benefit from this show, please pass it on to somebody else. It will help them. You'll be doing them a favour just like I've helped you, and maybe they can become a subscriber and we can keep sharing the message around, because the next year or two are going to be difficult for property, so I'm going to try and keep you informed, updated, and stop you being sidetracked and misled by all the wrong information that's out there. I've learned from my mistakes and from the mistakes of the many investors my team at Metropole have dealt with. So I'd like to give you some shortcuts of how to get success in your life. Thanks for sharing this time with me, and I look forward to catching up with you again next week. Remember, each week on Tuesday, there's a new episode of the Michael Yardney Podcast.
Thanks for listening to this week's episode of the Michael Yardney Podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property advice. If you got value from listening to this podcast, please leave us a review and we'll read it out on a future show. Just go to michaelyardneypodcast.com/review and it will take you over to iTunes, where you can enter a review and let us know what you think. We'd really appreciate it. If you don't already subscribe on iTunes or on your Android phone, you'll find us there as Michael Yardney Podcast. If you'd like to gain instant access to the show notes or a transcript of the show, head across to michaelyardneypodcast.com. Watch out for our show next week. You'll learn some new ideas about property investment, success, and money in around 20 minutes.